Welcome back to the deep dive. Okay, so today our mission is pretty specific. We're zeroing in on one stock, Orchid Island Capital. That's ticker ORC. We've pulled together a bunch of recent sources, analyst reports, financial data, all up to mid-October 2025. We really want to cut through the noise, understand the opportunity, but also, and this is key, the major risks involved here. Right, so ORC, for context, is a mortgage real estate investment trust and trades on the NYSE. And, when you first look at it, the thing that just jumps out is the yield. It's huge. But whenever something pays out that much, your first thought has to be, okay, what's the catch?
That's exactly the right question, and it frames this perfectly. This is a classic high-yield, high-volatility situation that you see a lot in the REIT space. Just to make sure we're all on the same page, maybe a quick reminder of what ORC actually does. See, unlike REITs that own buildings, REITs mostly borrow short-term, then invest that money in longer-term mortgage-backed securities. They make their money on the difference, the spread between what they pay to borrow and what they earn on those investments.
The net interest margin, basically.
Precisely. So our goal today is to look past that really attractive headline yield. We need to dig into the numbers, the Q3 estimates coming up, things like dilution, which is a big one, and how sensitive this whole thing is to the wider economy.
Okay, good plan. Let's start with how the stock's been doing lately, because honestly, it's been surprisingly, stable in the first half of October. Looking at October 1st through the 16th, we saw a moderate little uptrend. It closed on the 16th at $7.30. So that's up about, 1.53% for the month so far. Still comfortably inside its 52-week range, which is $5.69 to $9.01.
Right. And that stability is interesting, especially given, as you said, the main hook here.
The dividend. Let's get into that.
Yeah, the dividend is definitely the main story. So the company confirmed its monthly dividend for October 2025. It's $0.12 per share, and that's consistent with what they've been paying. But here's where it gets, really interesting. If you annualize that, the forward dividend yield is hovering near 19.7% as of mid-October.
Wow, 19.7%.
Yeah, I mean, for anyone looking for income, that number just screams at you. It's electric. But, and this is so critical for you to understand right away, in finance, a yield that high, that's not a sign of safety. Not at all. It's a clear signal of the risk the market is pricing in. The market demands that kind of return because it anticipates potential problems like the stock price falling or maybe even a dividend cut later on.
Okay, that makes sense. So that nearly 20% isn't free money. It's basically hazard pay for taking on a lot of uncertainty.
I'm going to say it better myself. It's compensation for risk.
And just so everyone has the dates, the sources confirmed the ex-dividend date is October 31st, and the payment date is November 26th. So that part, at least, is locked in for this month. All right, let's shift gears. What's driving the mood right now? Because the third quarter 2025 earnings are coming up fast on October 23rd. Seems like there's some optimism based on analyst expectations.
Absolutely. Those positive estimates seem to be putting a bit of a floor under the stock price, for now anyway. And for REITs like ORC, the number one metric, the thing everyone watches, is book value per share, BVPS.
Right, because their assets are mostly financial instruments, not like buildings you can touch.
Exactly. It's the best measure we have for valuing these companies. So the consensus estimate for BVPS as of September 30th, the end of Q3, is $7.33. Now, that's seen as a positive sign because it suggests maybe they managed their portfolio well in the quarter, perhaps even grew the book value slightly compared to the previous one.
Okay, $7.33 estimated BVPS. What else?
Well, the estimated GAAP net income looks pretty solid, too, at $53 per share for Q3. And that translates to an estimated total return on equity of about 6.6% for the quarter.
So if they actually hit those numbers on the 23rd, that definitely plays into the more bullish view on valuation. We saw one analyst source, Simply Walcent, mention a consensus fair value estimate around $8 per share for ORC. Yeah. And if you take that $8 seriously, at the current price of $7.30, it suggests the stock might be, 9 or 10% undervalued.
That's the argument, yeah. The idea is that maybe income can keep expanding because the spreads between mortgages and swaps are favorable right now. They're seeing operational strength.
And we also saw Zacks giving it good style scores for both value and momentum. That's pretty unusual, getting both.
It is unusual and powerful, potentially. But hang on. If the estimated BVPS looks decent, income estimates are strong, analysts think it's maybe undervalued,
yeah.
Why isn't the stock already trading closer to that $8 mark?
Yeah, exactly. That's the puzzle the sources throw at us, isn't it? It feels like the data is pointing in two different directions.
It does, and this is where we have to confront the big risks. The fundamental catch that seems to be making the market cautious. despite those positive signals.
What is it?
Okay, the core concern here boils down to equity dilution. It's kind of a necessary evil in the emirate world, but ORC seems to be doing a lot of it. Look at the numbers. Shares outstanding went from about 126.6 million back in June to 151.7 million by October.
Wow, that's a huge jump in just a few months, like 20% more shares?
Roughly, yeah. It's significant. Now, look, ours have to raise capital this way to buy more assets. That's how they grow their investment portfolio. But issuing shares on that scale, it comes at a cost to the people who already own shares. Think of the company's value, its book value, like a pie.
Okay.
When they issue millions of new shares, they're slicing that same pie into many, many more pieces. So even if the whole pie gets a little bigger because of the new investments, your slice as an existing shareholder gets smaller.
Right. So even if the new money earns a good return, just the sheer number of new shares waters down future earnings per share, and it puts pressure on the book value per share trend for existing holders.
Precisely. It's a growth mechanism that inherently dilutes ownership. That's probably the biggest internal risk factor weighing on the stock, affecting that BVPS outlook.
Okay, dilution is risk number one. What's the other conflict? You mentioned valuation signals clashing.
Right. So we have the BVPS story, which looks okay, maybe even good. But then you look at a different metric. The price-to-sales ratio, PS, and our sources show ORC's PS ratio is, well, it's incredibly high, sitting at 43.7 times.
43.7. That sounds really high for this kind of company.
It is. It's way, way above the average for the MRIT industry, which usually trades at much lower PS multiples. Now, technically, you can argue BVPS is a much better metric for an MRIT, right? Because they hold financial assets, they don't have massive sales in the traditional sense. However, when a PS ratio gets this extreme, it's like a big warning flag from the market. It suggests deep skepticism. It's like the market is saying, okay, your book value looks all right for now, but we think your actual operating profitability relative to your ability to generate revenue or sales is way overpriced. Or maybe your current revenue stream isn't sustainable. It's a major cautionary signal, even if BVPS is the preferred metric.
So putting it together, we have a value score and decent BVPS estimates suggesting maybe it's cheap, but at the same time, heavy dilution and this really stark PS ratio suggesting it might be overpriced or risky. It's confusing.
It is a genuine conflict in the data, and that brings us to maybe the biggest risk of all because it's largely outside the company's direct control, macro sensitivity. You have to connect ORC into the bigger economic picture. The external environment is really the ultimate driver here. Remember how they make money? That net interest margin, the spread?
Right, the difference between their borrowing costs and investment returns, which means they live and die by the yield curve.
They absolutely do. ORC, like all IRETs, is highly sensitive to what the Federal Reserve does, to short-term interest rates, and just the overall shape of that yield curve. You know, a steep yield curve, that's perfect for them. Borrow short-term, where rates are low, invest long-term, where rates are higher. Nice widespread.
Makes sense.
But the danger comes if that curve flattens, or worse, inverts. That means short-term borrowing costs go up, getting closer to, or maybe even exceeding, the returns on their long-term assets.
And that squeezes their profit margin instantly.
Instantly. The net interest margin gets crushed, profitability disappears, and suddenly that big dividend looks completely unsustainable. This is why MRITs are known for being so volatile. Any shift in interest rate expectations hits their bottom line directly and immediately. You just have to be ready for those swings.
Okay, that really clarifies the risk. It's not abstract, it's a direct threat to their core business.
Exactly. So given these, frankly, enormous risks, the dilution, the conflicting valuation signals, and this extreme macro sensitivity, let's try to synthesize the practical advice coming out of the sources for you. What should an investor actually do with this information?
Yes, let's distill it down.
Okay, advice point 1, be wary of the dividend trap. Yes, that 19.7% yield is incredibly tempting, but the sources explicitly warn that yields this high usually reflect significant underlying risk. And crucially, ORC has not set any kind of minimum payment level. There's nothing stopping them from cutting the dividend if profitability tanks or the book value drops, whether from dilution or macro shocks. Think of the dividend as high-risk compensation, not a guarantee.
That's critical. Don't get mesmerized by the payout number itself. Okay, point 2.
Point 2 focuses squarely on that upcoming October 23rd earnings report, that estimated BVPS of $7.33. Treat that as a benchmark. When the report comes out, you need to look closely at 2 things. First, the actual reported BVPS number. Did they meet or beat the estimate? Second, listen very carefully for any guidance or comments about future share issuance, about dilution plans. Seeing a stable or ideally increasing BVPS may be combined with some signal they're easing up on the dilution pedal. That would be a positive confirmation signal.
Got it. Watch the BVPS and dilution commentary on the 23rd. What's next?
Advice point 3 is about risk allocation in your portfolio. Given how high risk this is and how much depends on macro factors they can't control, the advice we saw was pretty consistent. If you invest in ORC at all, it should only be with a really small part of your overall portfolio. Make sure you're well diversified elsewhere.
Don't let that huge yield trick you into putting too many eggs in this one basket.
Exactly, because a significant drop in the stock price, which is entirely possible here, could easily wipe out any dividend gains you collect along the way. Overconcentration is dangerous.
Okay, this has been a really useful breakdown. It feels like the sources paint a picture of an investment that's, well, definitely not for the faint of heart. You've got this compelling short-term story for income seekers, that massive dividend, the positive Q3 estimates hinting at momentum. But it's running headlong into these persistent structural risks. The dilution factor, that worrying PS ratio, and the fact that its fate is so tied to interest rates.
It really is a balancing act. And maybe here's the final thought to leave you with. Considering the stock actually got favorable scores for both value and momentum from Zach's signals that often suggest a potential bubbling opportunity, the critical question you have to ask yourself is this. Does the fundamental inherent risk profile of an emirate, the sensitivity to macro events, the constant pressure of dilution, does that fundamentally outweigh the potential short-term gains suggested by those value and momentum scores? How do you, personally, weigh a nearly 20% yield against the explicit warning that it could be cut potentially sharply if things go wrong with book value, perhaps due to those external forces or just more aggressive share issuance? That's the calculation you really need to grapple with before considering ORC.